Welcome back. Today we are talking about beta hedging. Why don't we dive right in and I'm gonna go back to the same old boring screen of portfolio summary. What we have in front of us is what we've always looking at. Beta hedging. What is it? Beta hedging is a little number which represents the movement of a stock in relation to the index being S&P 500. If a stock is moving zero point 0.9 in regards to S&P 500, that means it's moving less than the S&P 500. Its average daily moves are actually less than the S&P 500s, meaning the volatility. So if a S&P 500 goes up 10 points, you're probably going to go up 9 points on that day, or more or less, more or less. The CCI over here, it's at 97. That's almost at par with the S&P 500. S&P 500 being the one, and that being the ratio we're going against. Why would I choose something that moves less? It doesn't really matter as long as you look at both. And the reason I say that is because beta hedging is really important in terms of risk management, and just keeping the volatility down to a minimum, the portfolio volatility down to a minimum. How do we do that? We figure out any one of the Seeking Alpha or Finwiz, each publish beta. If you go to Finwiz, let's say, and look up beta for GameStop, beta for GameStop happens to be 2.11, meaning that this stock moves twice as much as the S&P 500. So on a day where S&P 500 gains 100 points, this could, hypothetically speaking, be 211 points. This just represents the volatility of the stock itself, and it tells me that it's twice as volatile as the S&P 500. So in order to hedge out risk associated with stock trading, we need to beta hedge. And for a stock that has a beta of 2.11, you ideally would like to find something that has a beta that's matching or at least very close to it. The ratio between the two, if you take your long stock and your short stock, let's go back to the long short portfolio. The long being TIGO and the short being CCI over here. If you look at their beta, you would take this beta and divide it by the short. So you take the long beta and divide it by the short, and that will give you a ratio of 0.9278. What you do with that is let's say you are wanting to, like me, obviously on this trade, I wanted to risk $450. And if I risk $450, I get so many shares of $54.72 will fit in here 8 times. So I get 8 shares, and my actual risk is 437.78. That's 8 times the purchase price, 54.72, which is 437, and that's actually the risk on the long side. Now, how do we calculate the risk on the short side? You would take this ratio, you would calculate it like this. You take the 450 initial risk that you want to take and multiply that by the ratio. The ratio we found by taking this number and dividing it by this number. That's this here. And so when you do that, when you multiply this by the ratio, it gives you this number. This is how much money you should be investing into your short position in order to to hedge out the beta risk, which in this case over here, the ratio is very close to 1. This is a very nice trade. I have some which the ratio is completely out of whack, but I don't always use this. But this is a surefire method to make sure that if we do have stock market volatility, you don't end up losing 15-20%. You end up losing maybe 1 or 2%, maybe 3 if it's a bad day. So yeah, And so in this case, $417 divided by 5 shares of 84 bucks, and the total risk is 420.45 after actual risk is 420.45. That's actually a loser so far. In 41 days, this one's returned negative 4.66. But am I worried? Not really, because the total risk return for the trade, and every trade is a long and a short, is actually 8.31% on the invested capital, which is a month and a half. Let's say I got 8.5% on this trade. And if you look at NGD BAX is one of those trades which I'll be pulling the plug on. I've been talking about it since last week. I was hoping for this to bounce. It did not, and as such, I will be closing it. I will also be closing another trade, which we'll get into, but this one will get closed. So that's so much for beta and why we use it. That's to hedge out the risk. And so moving forward, let's just quickly go through the rest of the portfolio. It's going to be a very short video today, but in each one of the videos, we're going to look at a separate aspect of the entire summary or trade calculation that you see over here. Let's just reduce these to 90% so we can see this a little bit better. Yeah, this one, 8.5%. NGD backs. This one here, it's not working out all the best. I am going to leave the new gold, but I am going to take out the Baxter International. It's kind of tumbleweed on me there. It's only been a month. Maybe I should give it a little bit of time, but this one is minus 10%, and as such, I'd like to cut it at that point in time. And so I will. I will replace it with something else, and you'll see that next week. VFF Hubs, Village Farms International against HubSpot. 1% return in the same amount of time. Tumbleweeds, but spread. You got to give these things some time. Sometimes they drift together, sometimes they drift apart. Overall, if you give this time, it should play itself out. So I'm leaving this one closed because none of these are showing minus 10%. Celestica General Mills, that's the result here. Tumbleweeds again. Not much happening, but we'll hold on to it. None of them are losing. B line, so Barrick Mining and Lineage. This, this one is doing okay. It's 13%, and so far one is really long. Barrick Gold, I've had this for a little while. It's actually doing better than the short, but it's a winning trade. It doesn't matter. Keep it going. This is the latest addition from last week. You'll notice this is the one I replaced, Nesty. And so far the trade on the long and short side has returned about 17%. Nesty on its own is doing 3.5% in just 2 weeks. And then in 236 days, Adobe short returned 33.5%. Okay, Barclays and Flutter International. This one, the Flutter International was introduced 32 days ago, and that is already producing 33%. And I believe Flutter, we also looked at, I did that live on one of the videos, so that's the result. Barclays is returning 41. This trade is working itself out beautifully. You can see nice increase in the spread. The price is drifting apart yet again. Here's the beta, here's the ratio. Remember, your beta ratio, you come up with it by looking at the stocks, and you have an idea, and you're going to go long, you're going to go short, and then you look at the beta, and the ratio is like 2 point something. That's not the most ideal ratio to be playing with. You want that to be as close to 1. So this ratio between the two, this number divided by this number, and these are just the representative of the two betas again, should be as close to 1 as possible. They should be very close in terms of volatility. SSRM Roblox. This is SSR Mining against the software company Roblox Corporation. Both doing really well. The 241-day-old, it's 142% return. And then on the Roblox, which is last month's trade, I'm doing 16.82% so far. Altogether, a risk return of 79% or $821 over the period of the 241 days. So not the quickest, but a very nice return. And with this, you remember the shortest period of time you're going to be doing anything is going to be like a month to 3 months. I tend to hold on to it up to a year. And then if the stock is not doing anything else or the price has hit resistance or support, whichever one I'm looking at, I will close out the position. And we'll get to the one which I'll be doing soon here. There was one trade which lost 50%. It was a big pharma thing and 50% overnight. Nothing to brag about, nothing to cry about either. It's just one of 30 and easily replaced. King Cross Gold Corporation and Caspi KZ. 25% return so far. Price action confirms you want to keep it. Sienna Corp and Altasian. We're looking at a month and a half, and I am 47% up at this point in time. So $440 is one of the better trades. You can see the action happening here. The two prices totally drifting apart and a nice spread increase. Let's move over to the rest of them. Ponce Financial, GoDaddy. Ponce Financial, losing 2.5%, but the short is actually at 24%. And so the total risk return is 11.5% on this trade. And that's just 2 months. Newmont and Figma Inc. Both doing really well. Another one I'll be holding on to. No problems there. And profit is 8.9% on this trade so far. GRAL or Grail. This is the trade I was talking about. It lost 50% of its value overnight. You can see that right here. That was my long. It just dipped. They missed the results on their cancer trials. They returned. They showed their earnings a couple of days ago. Everything was stellar, and then they missed the results on the cancer trials, and I guess that's what all the hype was all about in Grail. So I will be closing off this position on Monday and replacing that, and I'll close a short, and I'll bundle together two trades which weren't together before. But you'll see that on the next video. I'll just take a short and I'll take a long out of the portfolio, and then the remaining long and short, put those together as a trade, and potentially get another trade going just to fill in the portfolio to the 30 trades that I go for. GSL code, Global Ship Lease, Americold Realty Trust. 82 days and 180 days old, return of 13.9, almost tumbleweeds. Now I'll be looking to liquidate this. It's not moving fast enough. So I will be looking into, give it some time, but I will be looking into liquidating this. Core Mining and Kraft Heinz, a year and a half old, almost a year and a half old, and that's almost a 30% return on that trade. Not bad, not bad indeed. What was I going to look at as well? There is a couple of trades which we've taken. One is Next Power against MicroStrategy or Strategy Inc. And this is the Bitcoin Michael Saylor NXT. I shorted Strategy 13 days ago, and I went long Next Power 27. And so far, this trade is returning 8% in less than a month. That's $67 on $830 investment. That's 8.1% return so far. So Next Power is doing okay at 13% return, and Strategy is giving me 2.8 return so far. We also looked at VSCO, which is Victoria's Secret, against HubSpot. HubSpot losing less than 0.5%. That's less than $2. But Victoria's Secret, the original long that we've picked a couple of videos back, that seems to be doing okay. And for a total return of 5.75% or $50 in 1 month, it's not bad. It's not bad. I'm going to give this some time to play out. What else do I want to look at today? We probably want to look at the ranges. Now, I've shown you this before, and positioning momentum in the market. The big boys are starting to turn negative. Like I said earlier, over and over, this is an indicator that I put together. It's based on the all investor sentiment. And when I see this go negative, I usually liquidate half of my positions, or meaning that my long only portfolio is probably going to get liquidated. I'm just going to sit on some cash. When it comes to the hedging, you either reduce the exposure by half, meaning you'll take 50% off the table and keep 50% cash but stay in the trades, or you can, play at high risk and just play, let it play out. But when these things go negative, I usually decrease or completely close out the long portfolio and reduce the long only. So when this goes below zero here, that would be the good time to take a look at that. It's already been happening, but the price action doesn't really show it. We still climbing new highs, and when these guys flip, they're still positive. There's still more buyers than sellers, and these are hedge funds and mutual funds and whatever banks, investment firms. When these guys start going negative, you don't really want to go against them. So that will be some time to act. Just an FYI. What else did I want to look at? I wanted to look at the map of the actual releases, earning day performance, earnings date. One thing to watch out for in the coming week, February 25th, we have NVIDIA and AVGO, Broadcom. Both of those companies are, what you're looking at in pink, first of all, is companies that are left in the market that will still be reporting their earnings. NVIDIA being such a giant, it has very big potential for, introducing a lot of volatility in the markets again. Then February 25th, watch out. There'll definitely be some jumping around. March 4th is the next, Berkshire and AVGO. AVGO will do more than, well, I guess it's comparable to Berkshire B, but NVIDIA, with its $4 trillion market cap, I believe it's the biggest company today. This will push the markets. So just watch out. If you're a leverage trader, watch out for February 25th. Anything I want to mention on Seeking Alpha? This is just where I track my trades long only. You'll see that it's the same representation of what I have here. It just shows you the long side and then the margin short. I can't open the TFSA on this video because there's a lot of trades in there that are proprietary. So margin short, maybe in the future we'll get into that, but margin short, these are the same positions in their returns. Anything else I want to say? ISM. Have we ever gone through ISM? I might as well. I think we've looked at it a couple of times. We're looking at a nice recovery. We're actually growing for first time in a year. And there's been a lot of negatives in the year prior to that, but 2025, the economy has been shrinking, and we're definitely taking a corner here. And prices have come down. The backlog of orders is climbing. New exports are climbing. Imports are also climbing, meaning business is being done. Tariffs are not. So things are starting to look up, actually, when it comes to the fundamentals. And this just looks at America's biggest companies and surveys them for the information. And yeah, that's what you get here. It's a report of the biggest companies in the United States and how well they're doing in their business. And it's called ISM Report on Business. And this one looks at manufacturing, which is the most important part of the economy. I think that's it. I think that's all I wanted to cover today. The biggest thing in this video was obviously the beta. Very important. Is it 100% necessary? Not so much, but then you're exposed to these big jumps, ups and downs. and beta hedging definitely works. Maybe let's go over that one more time just as a refresher. You get both betas by going to any website. Like let's say you wanted to get NGD beta, you'll go to Finwiz NGD, and you'll find your beta for NGD beta of 0.59. This one moves half as much as the S&P 500, but it's a gold company and it's in the low numbers, and I'm expecting good things. So anyway, yeah, there's a few things I wanted to talk about actually. A thing I added to the summary. This actually shows you like this. From this, you can't really tell what the companies are, but I keep on expanding this spreadsheet, like I said, and on the right side over here, what you'll see is, maybe let's put it together like this for now so you can see everything. I've also included the sectors. So what am I long and what am I short? But by looking at all of this, you can't really tell where the money is at. So I've added a couple of extra tables here with long allocation and short allocation. This is to be able to tell like what is my biggest exposure, where am I allocating my money? And on the long side, you'll notice like I'm allocating out of 15 stocks, 6 of those stocks are in gold. Okay, so I'm taking about a quarter of my money in the margin portfolio, the long and short portfolio, and I'm putting it on gold. Why? For obvious reasons. I'm also shorting a bunch of software companies, infrastructure and applications, shorting REITs, packaged foods, and the rest of them are just one of, essentially. But I'm obviously shorting real estate and software, and I'm long gold. Those are the two big allocations that I have. Software and REITs for shorts and gold for long. That's what's in the portfolio. Now, going back to performance, why am I long and short and then long only? Long only does not allow me to short, so I have to short in a margin account. But shorting allows you to expose yourself more, meaning every time you're shorting something, you're receiving money from somebody. So if you had $6,700 in your margin account, you can do a lot more exposure than long only, meaning when you're buying something, you're putting up the money for it, and the money in your margin dwindles. When you sell something, that money is being added to your margin, meaning you can use a lot more exposure. This long short account, it's only $6,700, but the exposure combined on those is 14,901. This gets a return of 30%, the long and short, whereas the long only has only 5.5% return to date. When you look at the account value of long only, the exposure there is 21%, and that's returning 5.5. With an exposure of 14.9, you're returning 29.23, and that's possible because the actual account value is only 6,737. This 14,901 is only there because as you're buying and selling, you're offsetting the money that you paying for something. You're getting some money back on the shorts because you're lending them money, and that way you're allowed to cover more ground. Now, imagine this account having $28,000 in it. You would multiply the 28,000 and you have over 4 times as much as over here, meaning that this return would be around $6,000 right now if I were just to even them out. And that's the beauty of long and short, is that you're getting lent money in order to trade, and you can still make money with it. And when it comes to just the numbers, it speaks for itself. I mean, we've been doing this since January 7th, and these are the results, and I'm just going to quickly scroll through them. And if you look at it, we started on January 7th with 0, and just slowly look at what's going on. And these are all my notes. If you haven't seen this channel before, like this is what I've done that day, and everything is updated on, on a weekly basis. Each one of these dark lines represents the break in a week. That's the weekend. This week we only had 4 days because we had a bank holiday on Monday, and so our next entry is going to be here and so forth. But even if you look at the charts themselves, let's just squish over this guy here. Look at the two charts, long and short, long and short. I'll change that later, and long only. Um, chart style, titles, chart short. Let's change that to short. Yeah. Look at the performance. Long and short, yes, it had some volatility during the same time when, you saw the gold and silver crash and the stock market corrected. But overall, it's it's a straighter line than this. We're actually in new highs in the long and short, and the long only struggling to find new highs. And once again, the return is the same, but if you multiply this by 4, you get 6,000 return right here, because that's 29%. That's almost a 30% return in just over a month. Let that sink in. And I'm sure like this number is bigger than this one, but you have to look at it with exposure in mind. What is the account value in the margin, and what is the account value in the long only? And the returns are pretty much the same. Now imagine I took this money and put it all in a margin. Yes, I would have to pay more taxes on it at the end of the year, but the returns are much greater. Why do I keep this in the TFSA? Tax-free savings account. And if you can register in one in Canada, up until now, I believe you're like allowed like 80 something thousand dollars you can have put into it. I haven't. It's only like I've only put in like 14 or something, and I'm gonna have to open up another one somewhere else because I'm just letting this one grow. But that's it. That's it. That's all I wanted to talk about. The beta was the most important aspect of this video, and we've covered that. Very important. One, is it 100% necessary? Absolutely not. But it definitely reduces a lot of this up and down in your portfolio. So the more you beta hedge, the safer everything gets. In the next video, we'll talk about risk management on a different aspect, but every week now I'll be doing a video about a different aspect of my calculations and the way I manage the portfolio itself. And if it helps you, it helps you. If it doesn't, it doesn't. If this video was boring, whatever, thank you for sticking around and watching the whole thing. And there's a lot more stuff to come. I want to share what I've learned over the years. And yeah, just have the best blessed week. And yeah, we'll see you in the next one.